QDTE and JEPQ are two very popular ETFs among yield-seeking investors. Both funds use covered call strategies to generate huge yields. But which one is better? Let's take a look. Right off the bat, we see that QDTE charges higher fee than JEPQ. As we'll see shortly, QDTE likely does more active trading, which is costlier. Next, both QDTE and JEPQ use Nasdaq 100 as their benchmark, but there are certain subtleties between the two. While QDTE tracks Nasdaq 100, Roundhill calls it Innovation 100 Index. In reality, it's just plain old Nasdaq 100. They removed the Nasdaq 100 references from their marketing materials a long time ago, otherwise they will have to pay licensing fees. QDTE does not invest in actual stocks in Nasdaq 100. Instead, they buy deep in the money call options on the index. If we look at their holdings, we see call options on Nasdaq 100. By doing so, QDTE gains the same exposure to Nasdaq 100 as if buying the actual Nasdaq 100 stocks. But call options are leveraged securities. This means that Roundhill needs less capital to have exposure to NDX. The main risk with synthetic exposures like this is counterparty risk. Also, the options that QDTE invests in are of so-called flex type. The flex options are different from the standard ones in the sense that they are customizable. The drawback of them is that the liquidity on them is not as high, and so the trading costs for QDTE can be higher too. And if markets go wild, the volume on these options can thin out and the bid-ask spreads can be higher. And so the trading cost as a result could also be higher. So most of the time the flex options are fine, but in high stress situations stuff can happen. Conversely, JEPQ holds Nasdaq 100 stocks directly, but not exactly one for one, because the goal of JEPQ is to generate lower volatility of its portfolio over some long periods of time, like 3 to 5 years compared to Nasdaq 100. And so for this reason, they use their own proprietary models to pick stocks from Nasdaq 100. Also, they can pick and hold other stocks outside of Nasdaq 100, although there are some limits. Next is the covered call strategy. You probably heard about it. It basically involves selling call options on the underlying portfolio of the funds, or Nasdaq 100 in our case. By doing so, both JEPQ and QDTE generate large income from those premiums that they distribute to investors. But of course there is a catch. By selling call options, these funds cap their upside. A known issue with covered calls funds is that they tend to lose money in bull markets. Likewise, they provide some downside protection, but it's very limited. In other words, covered call funds prevent investors from participating in bull markets and expose them to downside. Where QDTE and JEPQ thrive and may even outperform Nasdaq 100 is in sideways markets, meaning they will get better returns when the stock price goes nowhere. This allows covered calls funds to shine and generate large premium income without capping their upside. Let's come back to QDTE and JEPQ. There is one crucial difference in how these funds use the covered call strategy. Specifically, JEPQ does not sell call options directly. Instead, it relies on so-called ELNs, or equity-linked notes. ELN is a structured product that sells call options and distributes income to its holders. Conversely, QDTE employs covered call strategy, meaning sells call options directly. And with this comes one important tax consequence. QDTE distributions are classified as capital gains most of the time. Capital gains are taxed at preferentially lower tax rates, but JEPQ's income is taxed as interest income at regular tax rates, which are higher compared to capital gains. So there is some tax disadvantage to holding JEPQ, especially in taxable accounts. Either way, if you don't need income right away from QDTE or JEPQ, it is best to hold them both in tax-deferred accounts. Otherwise, you will be paying unnecessary taxes, which could be higher for JEPQ. Sometimes distributions from JEPQ and QDTE may be classified as a return of capital. I will come back to this shortly because This can be detrimental to shareholders.
There's another difference between JEPQ and QDTE. JEPQ sells call options that expire at least a certain number of days into the future. If we look at its portfolio, we see NDX 15 or NDX 17. These are likely equity-linked notes that sold call options with expiration of 15 to 17 days.
Conversely, QDTE is one of the first, if not the first ETF to sell 0 days to expiration call options. But how does it work?
Every trading day, a Roundhill portfolio manager for QDTE wakes up and looks at the market. Then he sells the 0 days to expiration options at market open or just shortly thereafter. These options will expire by the end of that same day, either completely worthless or in the money. Worthless happens when Nasdaq 100 stays below the strike price of 0 DTE option. That's an ideal situation for QDTE, because they get to keep the premium and not owe anything. But if Nasdaq 100 rallies above the option strike price by the end of the day, QDTE will lose money on this position. So what kind of unique risks these 0 days to expiration options expose QDTE to? First off, with 0 DTE options, their price moves can be very sharp and more unpredictable. For instance, markets can start in pessimism at around 9:30 a.m. But some good news on inflation or production comes out and Nasdaq 100 rallies. There are days like that. Conversely, JEPQ's sold call options with longer durations are likely not to be subject to such sharp moves.
And there are some days when the market can rally really big, like really big. It doesn't happen very often, but it does. And when that happens, it can obliterate all the premium income and put 0 DTE options at a big fat loss. It's also a problem with longer duration options, but perhaps it's a less of a problem because they are not as sensitive to these one-day movements, because perhaps they have more days to wait out and maybe Nasdaq 100 falls. Overall, this is just my speculation, and we don't know what are the long-term results from this 0 DTE cover call strategy. Seems like things are going okay for QDTE, at least for the past 6 months, so I guess we'll have to wait and see.
But one thing is for certain, selling 0 DTE options each day comes with lots of premium income. That is why QDTE is able to make distributions on a weekly basis. If we look into QDTE distributions since March of 2024, here's what we see: $8.78 for almost half a year. If you invested in QDTE on March 7 at a stock price of $46.44, your annualized distribution yield would be a whopping 41% if you didn't reinvest it. In comparison, JEPQ annualized yield stands at about 12%. It looks like QDTE is a clear winner, right? Well, not so fast. First off, there's no guarantee that QDTE will be able to sustain this high yield. If we look at weekly distributions, we see a lot of variation. Some weeks were extremely good, others were not so much. Why is that? The simple answer is volatility. High volatility of Nasdaq 100 produces larger premium income for both QDTE and JEPQ. For instance, we see that at the beginning of September of this year, volatility jumped. This has greatly benefited both funds. But when the stock market trended up or was making small moves, the income was really low. On the other hand, JEPQ makes distributions on a monthly basis. Its distributions also tend to fluctuate, but not as much as QDTE. Here's a comparison side by side of their distributions. Keep in mind that JEPQ makes its distributions at the beginning of each month. QDTE distribution amounts tend to jump around more. This is not surprising given its strategy to short 0 DTE options. It is exposed to high volatility of premium income compared to JEPQ.
Such sharp jumps may make it difficult for retirees holding QDTE to plan their monthly budgets. And if you were thinking of relying on this 40+% yield, I don't think it's a good idea. If markets stop being volatile or if the interest rate goes down, this will make the distributions lower for both JEPQ and QDTE, but it will be especially pronounced for QDTE. And of course, we have to look at the total returns. Distribution yields, after all, tell only part of the story. Even though QDTE, for instance, distributed almost $9 for the past 6 months, its price declined by $4.
When comparing the performance of QDTE and JEPQ, the verdict is not clear. QDTE is a new fund. For instance, for the 3-month, QDTE outperformed JEPQ. Same thing happened on a 1-month basis. This is intriguing. Will this persist into the future? I don't know. In the last 6 months, Nasdaq 100 showed a lot of up and down volatile movements with a sideways pattern. This has benefited QDTE to a larger extent than JEPQ because of those zero DTE options. QDTE can underperform JEPQ if there are sharp daily upward movements of Nasdaq 100. Overall, QDTE and JEPQ will underperform Nasdaq 100 with almost certainty over long periods. For instance, JEPQ underperformed QQQ. QQQ tracks Nasdaq 100 without any covered call strategies. Sure, there could be differences here and there, but if Nasdaq 100 trends up, which it tends to, JEPQ and QDTE will likely lag in performance. That's just how covered call funds work by their design. They trade price upside for a regular income. As for volatility, so far QDTE showed higher fluctuations compared to JEPQ. We don't know how volatility will play out for QDTE going forward, but it will probably stay elevated due to the nature of its zero DTE options.
But there's one huge caveat to all these total return numbers. This is very important. These total returns are dependent on you or me reinvesting these distributions. In fact, if you look at total return stats on Morningstar or Yahoo Finance, they all assume that we reinvest distributions.
Most people invest in QDTE and JEPQ to take out income. This alone grossly lowers total returns for these funds, and the higher the distribution yield, the more pronounced this return deterioration is. So without reinvesting, QDTE total return will be much lower. So take these total return numbers with a grain of salt if you are planning to keep distributions.
Another issue to contend with JEPQ and QDTE is the NAV or principal erosion.
Net asset value or NAV is the value of all assets that a given fund holds minus any liabilities or debt it owes. Once we net everything out and divide NAV by the total number of shares of a fund, we get NAV per share. It is approximated by the fund's stock price, more or less. So NAV erosion is just a fancy way of saying that the market price of a fund declines.
NAV erosion obviously happens when a fund generates losses, but in the case of JEPQ and QDTE, this can happen when they make distributions without generating sufficient earnings to back them up. And this can happen especially when there are large losses on covered call positions.
So if we look at the price per share for JEPQ, we see that since its inception, its price actually grew, although there were many down days too. If we zoom in on a 6-month period, it's break-even. Conversely, QDTE has seen a large decline in its market price of almost 10% since its inception. This is a sign that QDTE distributions likely exceeded what the fund earned in this period.
When the fund distributes more than it earns, these distributions count as a return of capital. Return of capital distributions do not generate taxes. Instead, they lower the cost basis of investment. So in a sense, they are like tax-deferred gain. Even in the future you sell your investment in, say, QDTE, you will be paying larger capital gains due to lower cost basis. So why is this entire discussion on NAV erosion important? It is important because if the NAV per share starts to go down long term, the fund may have less capital to deploy to generate income. And if that happens, these massive yields that these funds advertise will plummet. In a sense, it's like a fund giving your money back instead of reinvesting them to earn capital gains or dividend income. One way to counter NAV erosion is to take part of your distributions and reinvest them in the shares of the same ETF or some other fund.
The simple back-of-the-envelope way to figure out how much you need to reinvest is to look at the price action and see where it stands in a year or some other longer period of time. It is possible that the recent decline in QDTE price is temporary and it may rebound. If not, you may have to reinvest at least part of your distributions. For instance, the price decline was roughly 10% or $4 from March to October. Over the same period, QDTE investors received $8.78, so you will have to reinvest at least $4 or 45% of your distribution income to counter NAV erosion. Of course, this is a rough and imprecise estimation. Conversely, if you look at JEPQ, it did not show any NAV erosion.
I think that to assess the NAV erosion, you have to look at longer periods of time, at least several years. And as I mentioned, both QDTE and JEPQ prices tend to fluctuate, and while QDTE is down today, it may very well recover. And probably the managers at Roundhill and JP Morgan know about this issue, and they try to manage their distributions accordingly to avoid it.
You can also go and check for yourself how these funds accounted for distributions. For instance, here are the financial statements for QDTE accessible through their website. It started with a NAV per share value of $45.72. For the period ending on June 30, QDTE generated investment income of $347, but distributed $3.78. We see that distributions exceeded its income. The NAV per share decreased slightly. Potentially there's some part of return of capital sitting here, but in another statement, QDTE says that its distributions were from earnings and none were of return of capital. This could be due to differences between financial and tax accounting books, or maybe I'm missing something here. Also, this is just 6 months or so. We'll have to wait for the entire year to see what happens.
So overall, I'm against vilifying or glorifying any ETF. Clearly, these funds come with their own costs and benefits. And with QDTE employing zero DTE options, it makes it much riskier, and it may or may not match JEPQ long-term performance. Playing with 0 days to expiration is the new thing, especially among ETFs, and we don't know how it will play out. But as long as you and I know the pros and cons of these funds, I hope we can make a better decision. And this is what this video is about, and I hope I was able to help you in this regard. And that is it for this video. As always, thank you so much for watching. If you enjoyed it, please give it a like and subscribe to my channel for more interesting content on ETFs and other investing topics.